Welcome to Knopman Mark's SIE Video Vault. My name is Dave Meshkov. I'm a partner here at Knopman, and I'm thrilled you're going to join me as I walk you through some of the toughest topics and concepts on the SIE through guided, curated Q&A. We're going to be breaking down topics like customer accounts, investment companies, tax advantage accounts, and more. Let's dive in.
A customer opens a margin account and places her first trade to buy $3,000 worth of stock. The amount of cash she must deposit is, and I got 4 different numerical amounts. How much margin must she deposit? Remember, margin is the term that describes how much cash the customer has to put down. How much cash is the customer's cash, the margin that she needs to contribute to the account, and the rest of this can be borrowed. The rest of this $3,000 purchase can be financed. So is that going to be $1,000, $1,500, $2,000, or all $3,000? What do we think? What's the amount of cash that must be deposited on your margin trade? Well, it's going to be $2,000. $2,000. And I like to think of this as a question where you have to navigate between a couple of different particular rules. A couple different rules could be in play. We have the FINRA rule in play. We're in the lower end of the purchase spectrum. And then the Federal Reserve's Reg T rule as we move into larger purchases. Let me show you what I mean here with this chart. And so what I'm going to do is walk you through the way that these two rules, the FINRA rule and the Reg T rule, operate as you want to buy different amounts of stock. Now you can see on the bottom we have the transaction amount. On the left-hand side, if you're buying $0 all the way up to $6,000. And then on the left-hand side, you can see I have the required deposit or the margin that you have to post. When we're in the green section of the chart, the FINRA rule is in play. When we move into the blue section of the chart, the Federal Reserve's Regulation T is in play. So let's walk through it. For the first $2,000, FINRA says you have to deposit 100% of the purchase price. Thereafter, once you hit the $2,000, you have to continue posting that same $2,000 until you get to $4,000, at which point Reg T's 50% comes into play. And so it's dollar for dollar up to $2,000. You're at a flat $2,000 between $2,000 and $4,000, and then you go up at a 50% threshold once you're moving between $4,000 and upwards. So in this case, we're at $3,000. We're dead center in the chart. The FINRA requirement is in play. We have to post the full $2,000 of margin, and we can borrow the other $1,000. What's a little interesting here is this customer could have actually purchased $4,000 and put up the same $2,000. Anywhere between $2,000 and $4,000 of stock purchased requires a $2,000 deposit. If you look at choice B here, that's a fake out where it's 50% of your purchase price. But remember, when you're in the small ball range, when you're talking about investments of less than $4,000, FINRA says, no, it's not going to be just the 50%. When it's less than $4,000, we're going to make sure you have either dollar for dollar, less than $2,000, and $2,000 minimum at all cases. And so be aware and ready for a margin question that really teases apart the FINRA rule or the Reg T rule. And remember, once you hit that $4,000, you're in the clear to move to that Reg T 50% margin deposit, that 50% down payment. Which of the following statements accurately describes the tax status of a Roth IRA? So we got some long answer choices here that we got to dig into. Great option here to think through and project. What do I look for the Roth IRA? Hopefully you remembered post-tax contributions, tax-free distributions. Let's see if we can find something that looks like that. A, contributions to a Roth are always non-deductible and only the growth is taxed as ordinary income. Well, non-deductible is the same as post-tax. So I like the first part of this sentence. But what about that growth part? Are we going to get taxed as ordinary income on distribution? No. What is taxed as ordinary income upon distribution? What kind of IRAs? Traditional IRAs. face that ordinary income tax on distribution, not the Roth. B gives us the same setup. Contributions to a Roth are always non-deductible. We like that part. The growth is taxed as capital gains. Have we heard about any retirement plans where the distributions get capital gains treatment? No, we haven't. So B is not going to work for, again, incorrect distribution description here. How about C? Contributions to a Roth IRA are always non-deductible, and qualified distributions are completely tax-free. That's what I projected that I was looking for. Here it is, and boom, it's the right answer. I don't skip D, I do check it, but C was exactly what I was looking for, so I'm going to be reluctant to move off it. D tells me contributions to a Roth IRA are always deductible, and qualified distributions are completely tax-free. No, that's not correct, because the first part, that they're always deductible. And remember, we've talked about in prior Vault videos how when you see 3 answer choices or 2 answer choices that offer up the same idea, contributions non-deductible, contributions non-deductible, contributions non-deductible, that's sometimes a signal that that's partly true. They're giving you the words, all right, we're talking about non-deductible or post-tax contributions all over the place. More likely than not, that's the true part. And then it's the second part of the answer choice that's actually doing the work, differentiating the students who know the rules from those who don't. An investor owns 100 shares of ABC Corp stock purchased at 67 and writes one ABC November 70 call at a premium of 3 per share. What is the investor's break even? This is a straight up math question that you could get. And this is the kind that if these are really challenging for you, right, then maybe this is the kind of question you say, I'm not going to focus that much study time and study effort on it. Not that I don't want you to get it right, but that we have a goal and a mission here to pass the exam, which does not require that you get every single question right. So I'm going to walk you through how I like to think about these. But again, if the math questions on options just jam you up, let's be strategic and tactical in how much time we're devoting to picking up the 1 or 2 questions that might show up with this kind of math. Now, before we dive in, what kind of transaction is this? How would you describe this? We own 100 shares of ABC and we sell an ABC call. This is what we were just talking about. What kind of call is this? We sold a covered call. We don't have that much risk here to ABC because if ABC goes up, 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 and I'm forced to sell 100 shares at $70 because I wrote that November 70 call, I'm not going to have to buy them in the market. I've got them in my account. And those are the shares I can use to make good delivery. Now, when we talk about the break even on a covered call, we want to remember that the stock position's dominant. Everything's going to be keyed off that $67 price that we paid for those 100 shares. And what I've laid out for you is a first position, second position premium chart as the way I like to unpack these kind of questions. And so the investor's break even here, I'm just going to test, well, what happens at 64 and what happens at 73? Those are 2 of the answer choices that I'm looking at and thinking, maybe one of those is right. And I'll see if that's the case. Now, the first position I just analyzed, if I'm long 100 shares at 67 and the market value's down to 64, what happens? Well, I lose $3 on that stock trade. I bought at 67, I sold at 64, I'm down $3. The option position, I sold a 70 call. My counterparty has the right to buy ABC at 70, but what's it worth? It's only worth 64. Are they going to take advantage of that? Anybody going to buy $64 stock and be like, no, I want to overpay. I want to pay $70? No way. And that's because the option's out of the money. When the market value, 64, is less than the strike price, 70, the option expires worthless. So as of now, I'm down $3. But what was the other part of this options contract? Well, I collected a premium of 3. I brought that in. And so what happens at 64 market value? I, in fact, broke even. I lost $3 on the stock. I bought it at 67. It's down to 64. But where did I offset that loss? By the $3 premium I brought in. Let me just show you the way this works. Let's say you thought it was call up. A lot of folks know the phrases we use, call up and put down. Those only work for your option only positions. This is a stock and option position, so it's a little bit different. But in this case, check it out, 73, we don't have to remember it. We can just see what happens. So I bought stock at 67. It's up to 73. Woohoo! Big money there. We made $6. Right, I bought at 67, sold at 73. But the options contract is going to be in the money. The market value at 73 is more than 70. And so in this case, I'm going to go into the market, buy the stock at 73, turn around and sell it at 70, the strike price, as I'm required to do, and I take a loss of $3. And now some of you might be thinking, Dave, but what about the fact you already own those shares? You said you didn't have to go into the market, and that's true. But using this setup, I like to separate the two positions. And I just say, what happened to my stock trade? Boom, that's that first row, first position. What happened to my options trade? Second row, second position. And I integrate them at the end when I sum all the outcomes. And so the outcome's the same. If you're able to see it and say, well, you take the $67 stock and you sell it at 70, that's fine. You're welcome to do it that way. But this is a little bit of a more methodical, clear approach. So again, first position, I made $6. Second position, I lost $6. Premium, still got $3 coming in. Check it out, stock went up. I made money. I made money. And so I made $6 here on this transaction. And I can confirm that 73 is not, in fact, the break-even. Where was the break-even? Back at 64. And we saw that by writing that call, we actually provided a little bit of a hedge in the amount of the premium that we brought in. When comparing a 529 plan and a Coverdell, it would be accurate to say that A, a Coverdell has a higher annual contribution limit. Is that accurate? No. The 529 has a much higher contribution limit than the Coverdell. The Coverdell's contribution limit of $2,000 per student per year is quite low. B, is it accurate to say that unlike a Coverdell, a 529 plan has an age limit by which the assets in the account must be withdrawn? Is that accurate? No, that's not accurate, because Coverdells do have an age limit by which you have to make that withdrawal. What is that age limit? For the Coverdell, the assets have to be withdrawn by the time the beneficiary is 30 years old. Now, what about the other part of the answer choice, the 529s? Well, this answer indicates that there is an age limit for 529s, and that's also incorrect, because 529s do not have an age limit. How about C? Is it accurate to say that both plans allow for tax-free distributions when the funds are used for education? That sounds really good to me. I'm going to flag that one. I'm still checking D. Is it accurate to say that both 529 plans and Coverdells are considered municipal fund securities? Is that accurate? No, it's not. Which one's the municipal funds? Which ones are offered by the states? The 529 plans are municipal fund securities. The Coverdell accounts was created by the federal government as a way to save for education. So useful to know both of these. Remember, both these plans, the 529 and the Coverdell, they operate like Roth accounts, post-tax contributions, non-deductible contributions, same idea. The money goes in post-tax, and then as long as it earns and grows and gets used for education, tax-free distributions. All the following are key differences between exchange-traded funds, ETFs we were just talking about, and mutual funds, open-end funds, except. So 3 of these are key differences between the products. Love it. Make sure you know these 3 when you leave the question. Which one of these is not a key difference? Which one's not a key difference? So is it a key difference between ETFs and mutual funds as it relates to how orders are priced? Sure it is. How are those 2 products priced? Well, the ETF is based on supply and demand on the exchanges. Where are willing buyers and sellers willing to trade the securities? Whereas the mutual fund, how are those orders priced? They get the forward price. When is it priced? At 4 p.m. the next business day. How about B? When the shares can be bought and sold? Well, just the same, the exchange-traded fund, if you're on the exchange, when can you trade? all day long, intraday, from 9:30 a.m. all the way up till 4 p.m. Whereas for the mutual fund, when can you buy and sell those shares? At the next forward price. That's at 4 p.m. Again, I'm just going to hammer that silly way to remember it. But if you think, boy, Dave, that's crazy, like, come on, it's going to stick and you're going to remember it. How about C? Is it a key difference between ETFs and mutual funds that they offer the ability to diversify assets amongst many securities, the ability to diversify? Is that a key difference between them? Maybe, but maybe not. Maybe do both of these products offer this ability? Is there not really a difference as it relates to the ability to diversify? Maybe not. Let's take a look at D. The ongoing costs of ownership, that's going to be a key difference with the mutual fund having that higher expense ratio and more active management versus the more passive and index-focused ETF product. The mutual fund typically, and for the exam, being a more expensive offering. So again, in the real world, you do have more passive mutual funds, index-based mutual funds. You may have some active ETFs, but for the exam's purposes, the ETFs are passive, the mutual funds are active unless said otherwise. So C in this case is actually something that's not different. Both the mutual fund and the ETF allow you to diversify assets among many securities. So check it out here. I have a little diagram for you at the bottom as we wrap up this Vault video with the investor here who has purchased either an ETF or a mutual fund. I bought one share here. Maybe I bought the ETF intraday on the exchange. I paid my commission. Or maybe last week, a couple days ago, I placed my order to buy shares of a mutual fund and I got the forward price, the next net asset value plus a sales charge. In both cases, what does that ETF or that mutual fund represent? Well, it represents ownership of a whole diversified portfolio. Every one of these shares that I put up, and this is just an illustrative list here, is encompassed in my owning that one ETF share or that one mutual fund share. And what's going to drive the value of that ETF share or that mutual fund share? Well, the value of all those stocks within the mutual fund. And maybe that ETF or that mutual fund is showing 500 stocks if it's an S&P 500 fund, or 5,000 stocks if it's a Wilshire 5000 fund. Or maybe it's a hand-selected group of stocks that a management team has decided is the kind of way that they're going to achieve your investment objective.
Thanks for watching. I hope you found this video helpful. And if you did, be sure to check out our full SIE video vault where there's hours more of content just like this. Best of luck on your exam, and I hope to see you soon.